you had you've had your great Christmas party on the harbour on Friday, and you would have spent, you know, Saturday maybe recovering a bit and Sunday with the family. Is that what the weekend's been like?
That's pretty much it, Tom. Spot on there.
Yes, I thought so. Now, Louis, the other thing that you did say on the rant that you did with us come March, I think, or might have been April or May, I can't remember. But you said, once this is resolved or heading towards being resolved, the words you used, we're off to the races. We've got incredible grants. We've got incredible low interest rates, and they have got lower since then. And Louis, that's what's actually happened. In fact, I will say to you, to me, it appears that house prices that I'm auctioning, particularly the middle and outer, which is interesting because it's not the inner this time, it's the middle and the outer, have gone up higher than what they were pre-COVID as far as I'm concerned. That's houses. I'm not talking about units.
Yes.
So Louis, I would say that whilst you didn't say, well, you did say we're going to go off to the races, but a lot of other people actually said, this is what a lot of other people said. I mean, there were some people that forecasted 30% drops, and they were headlines that, you know, a lot of the media organizations used in that period, you know. Some forecasters said 20%. I'm not going to name them, but I mean, no one really got it right, but you got it less wrong. You definitely got it less wrong.
Tom, just calling it straight, we did put a scenario out there where if the government did not intervene in a housing market and the second wave was going to be seriously messed up, and it certainly was for one state, that potentially we could have had a housing crash on our hands. Now, as it turned out, that darker scenario was averted through very strong government action, actually more stronger than what I anticipated they would do. I thought they would come into the market, but the way that they've come into the market through various actions has helped avert that darker scenario from playing out. And as we did talk about it on the start of this, we have been off to the races, really, I think, on our numbers since about the month of September. So it's quite strange to say that, yes, as the year draws to an end, house prices, and I do decipher between houses versus units, house prices in Sydney look like they'll finish the year up by about 3.5% to 4%. Now let's keep in mind that, yes, early in the year they were falling, but once the panic started to go, the government intervention started to really kick in terms of JobKeeper, also in terms of the banks holding back on forced sales, the interest rate cuts. It has been a stimulus to the market, and more buyers have been looking to come into the market. And sure enough, we are going to end the year up with houses. Units are another matter. Units are still falling, particularly in the Sydney CBD.
Now, Louis, in a moment, I'm going to get you to bring up a slide that's got what actually happened for the 12 months to 2020. This is actual data. It's going to look at each city. And what's been interesting is the winner has been Canberra, which has had 6.8% increase. And Sydney's been good. It says 6.1. So this is the combined data. And then we're also going to look at your forecast. And the forecast, you as an organisation put out a forecast last week, and you've done what you've done in previous years, which is taken in 4 scenarios. So, Louis, what appears, and I read your document today, you are very bullish about Perth.
Shall I share the screen now, Tom?
Yes, absolutely.
Okay. Please let me know if you can see this.
Yes, we can, Louis.
Okay, fantastic. So as some of your audience would be aware, we like to run scenarios each year when we do our forecast, and then we put our hat on which one we think is going to be the most likely scenario. But let's run through the actuals first. So these were taken at the time that we produced a report back in the 22nd November. It appears as though dwelling prices are going to, were up at that point in time by 3.5% for the last 12 months. And I think if we run it through to 31 December, that number is probably going to edge up to maybe closer to 4. The cities which have outperformed, you pointed out, Canberra looks like the market's up by about 6.8%, followed very closely by Hobart, up by 6.4%, and of course the surprise there, which is Sydney, which is up by 6.1%. Melbourne is flatlining, and that's all dwellings. And so when you take into account the falls in unit prices, and as mentioned before, unit prices are still falling, most of that attribution of the performance is towards houses, large properties, particularly in the middle and outer ring of Sydney. And there's a very good reason why that's going on.
What's that, Louis?
Well, people have been looking to get away from the inner city area due to coronavirus. We first noted this trend from about the end of March, where rental vacancy rates started skyrocketing in the Sydney CBD and in the inner city area. When I say skyrocketing, the Sydney CBD rental vacancy rate got above 10%. And they moved to the outer rings, and they moved to areas such as the Blue Mountains, the Central Coast, and even further afield. Indeed, all of regional Australia has recorded falls in rental vacancy rates. And I think it's been the combination of people wishing to get away from everybody else due to COVID, as well as the ability, the ability to work from home using current technology, such as what we're doing right now, Zoom. And that enabled people to make that move further afield. I also believe, through speaking to people on the ground, agents on the ground, that many have used COVID as a catalyst for a lifestyle change they actually always wanted to do. And so the question that's been running in my mind for 2021 is, will we see a reversal of that? Will people start to move back into the city once COVID is truly behind us? And I suspect the answer will be that there will be some reversal, and we can talk about what some of the reasons behind that, but there'll also be a large proportion of people who will decide to stay in regional Australia and outer suburban Sydney.
Now, Louis, I'm going to give you an anecdotal conversation that I overheard at a cafe in Byron Bay about 2 months ago. I'd driven there for business purposes, and I was sitting at a cafe and I was listening to two people talking, and one of them had left Melbourne earlier on this year, had bought in the Byron Bay area, and he was saying, after living there for 4 months, Louis, he was saying, the words he used is, I'm not 100% sure on whether we've done the right thing. And the other guy said, why is that? And he goes, we might have bitten the bullet too soon. He goes, my wife's already missing, her family and her friends, and the kids aren't over the moon. And quite frankly, he said, winter in Byron is not as fun as what it was when we're holidaying in Byron. So, right? So there is, so Louis, and it's a really interesting observation that what happened, I believe, during the period after the Spanish flu, where a lot of people thought the way that you'll protect yourself is to move away with distance. What happened was weird that a lot of people returned back, because fundamentally, I think human beings are people that need people around them. Now,
Yes.
maybe they can find them in regional areas, but so what you're saying is the real big question mark is will that shift that took place and is taking place right now reverse in some way in the future when there is a vaccine?
And I think the answer is it will, but it will not be a complete reversal. I think you're right about many people who will have done a few months in regional Australia and have had a taste of it and have not liked it. And they miss their family, as you rightly say. Importantly, they miss amenities, which they will get in the cities, of course, but they will not get in regional Australia, not yet anyway. And they will want to come back. And on top of that, let's also consider that the inner city apartment market has had price falls, and importantly, it's had big rental falls. And I really do mean big, Tom. So at the start of this, a standard 2-bedroom unit in a Sydney CBD would have rented for about $1,000 a week. And that same unit has fallen to $700 a week. So we're talking about a 30% decline in rents for the CBD, which is huge.
Well, Louis, even in the inner west of Sydney, in some of my own property, I know that I've got units that were getting $450 a week rent, and after being vacant for 6 weeks, I just said, slash it, get someone in there, and in the end, one of them got rented at $295. I know anecdotal stories that I speak to. A guy that works at a cafe, he's had a unit vacant for 6 weeks in Petersham, and I said, listen, $50 is not enough to drop it. I think you got to drop it from, $450 not to $400. You probably got to drop it to $300. So you're absolutely right. I've never, in my 35 years in real estate, Louis, I have never seen the amount of discounting and vacancy as I'm seeing in the inner apartments, inner city, inner west, city central type of apartments. So that is definitely something that we've seen. But also, Louis, maybe a part of that's probably happened because in that inner city, a lot of the university students were taking up accommodation, and they've cleared out, a lot of the ones that gone back to Asia.
That's exactly right. And of course, we're also aware that the international border remains closed and is likely to remain generally closed for the foreseeable future, yet we're still completing new dwellings. So while we think that there will be a part reversal, it is still likely to be a tenant's market in 2021 and a buyer's market for inner city units in 2021. It's not going to be a great time for sellers for that part of the market. However, the flip side is that house prices for the middle and outer rings are likely to record pretty strong gains, and indeed the leading indicators such as auction clearance rates suggest that that is a market on the move. As you can see in our forecast table as we go back, the forecast for Sydney is that we think dwelling prices are going to rise between 7 to 11%.
Okay, so
I think it's going to be more towards 11% for freestanding houses.
So Louis, scenario one, let's talk scenario one is if interest rates stay the same. Can you just explain for the viewers here what you mean by QE?
Yes, that's quantitative easing. That is a policy tool the Reserve Bank of Australia started this year effectively, which is electronic money printing. It is the Reserve Bank of Australia buying the treasury bills of the federal government. So as we're all aware, the federal government is running a massive deficit right now, huge, okay, well north of $200 billion for a year, okay. They run a deficit. How they do that is they have to issue treasury bills to the market to raise that cash to spend it on the economy. Now, normally the market is the international market. It's investors who buy these treasury bills. But the Reserve Bank of Australia is buying these treasury bills instead, and they're doing that to keep the interest rates low. but effectively it's electronic money printing. The Reserve Bank of Australia is a government department. It reports into the government. So this is today's version of money printing. That's what's going on. We're seeing money printing to a large tune. And one of the assumptions we've got in our forecast is that that continues on, and indeed it could expand. At the moment, the Reserve Bank of Australia's quantitative easing program is set at $100 billion. We think it's going to expand further, and that's one of our assumptions in our scenario.
So Louis, I'm not the most educated economist, but on the surface, that sounds to me like a bloody great idea. Just print money. There must be a price to pay for it. So, I mean, that just sounds like a great idea. Have a machine, print money, just give it out to people. Like it sounds like it's too good to be true. What are the consequences of that? Are there negative consequences of that?
My word, there are negative consequences, and that is that the gap between rich and poor will widen big time. Those who have assets will stay ahead or at least stay neutral. Those who don't have assets will fall well and truly behind if this continues in an expanded way. In periods of great inflation or great money supply, you've got to hold assets. Cash in a bank is effectively debased. You've got to hold assets. That's what it's about.
So the rich will get richer and the poor will get poorer.
And that will create social problems for us, Tom, medium to long term. Okay, so it's not a good thing for anyone long term. Let me tell you that. But over the medium term, if this continues, or if I'm right, if it expands, those who have assets will hold ground or get ahead. Will certainly get ahead of those people who don't have assets. So I think it's a bad thing long term, but how do you hedge against this situation? You hold assets. That's what you do.
So scenario one, I presume, Louis, is a scenario here that you're saying JobKeeper is extended to September quarter 2021. And I read your report. It appears that a lot of the good news is underpinned by an extension of JobKeeper.
This is true. Now, this is one of our key assumptions. Now, as we stand, the government intends to scale back and completely phase out JobKeeper by the end of the March quarter. Now, if they do that, if they stick to their word, potentially they could be taking JobKeeper away too prematurely, just as the economy is starting to pick up. Now, if they do that, our forecasts on the housing market are a little bit more softer, particularly for Melbourne and Sydney, because we believe JobKeeper has been instrumental in saving many hundreds of thousands of jobs. Indeed, the Reserve Bank of Australia said it's saved about 700,000 jobs to date, and it's also helped save businesses. And we know that many of Australians' small to medium-sized businesses are located in Sydney and Melbourne. So if the government takes away JobKeeper too prematurely, and I think the end of March, which is only just over 3 months away now, that could be too premature. I think the economy right now is still soft. It may well be out of recession, but it's still soft and it's susceptible to any government effort to take away stimulus from the economy.
Now, scenario number 4 is the worst case scenario.
Yes, it is, though it's not that bad because scenario 4 assumes JobKeeper stays with us for a long time, but it's not a grand scenario. It's a scenario where the vaccine effectively fails.
Yeah.
Where international and state borders remain closed.
Yeah.
Where interest rates go into negative.
Yeah.
This is not a scenario we want, Tom, as a community. But given all the stimulus that would occur in such a scenario, the housing market potentially would still actually do okay itself. But I suspect we'll have a load of other problems on our hands.
Why are you so pumped about Perth in your scenarios?
Right now, excuse me. Right now, the Perth housing market is starting to take off. Rental vacancy rates are below 1%. Rents for 2020, market rents rose by 9% for the city of Perth, which is a huge rise for 1 year. The iron ore price is currently running at around $145 a tonne, which is great for the state of WA. So the state of Western Australia is moving forward on the back of big rises in base commodity prices. On top of this, Perth is offering considerable fair value right now. The median house price in Perth is actually lower than what it was over 10 years ago.
Yes.
The market hasn't done anything for a long time. And one thing we've also noticed in the past is that the rental market in Perth tends to lead the rest of the housing market, either in going into downturns or going into upturns. And right now, as mentioned, the rental market is running very strong in favour of landlords there. Rents have risen by 9% in the last 12 months. So these are some of the reasons why we're very bullish on Perth.
Now, Louis, if what I might do is just talk to you roughly about those other, the other scenarios that you've got there is the potential scenario that the vaccine is scenario 3. The vaccine is rolled out, in the first half of the year. We have a bounce in employment. We've got no more lockdowns. JobKeeper is phased out as planned. That's not a bad scenario either there. The JobKeeper goes, not a bad scenario.
Yeah, it's at the moment, I'd have to say, even just a couple of weeks after we put these scenarios together, scenario 3 is probably picked up a little bit in terms of probabilities.
Right.
Where at the moment, as we know, the news is that the vaccine so far is looking good.
Yeah.
It's started to be rolled out to a couple of countries, and overall the results have been reasonably good. We have seen a little bit of a bounce in employment. We've got currently the state borders have opened, which is good, but we've still got the international border closed, and the government has not made any noise yet about extending JobKeeper. So in this scenario, this is a more optimistic scenario for the economy, but the housing market is still somewhat negatively affected by the reduction in JobKeeper in our view. But Sydney itself would still record price rises due to all the job creation that's occurring and the optimism in the economy.
So, Louis, I might get you to stop sharing. That way I can get you on the whole screen because it's a better experience for all the viewers that are watching you. I want them to see your charismatic face. So
I got a face for Zoom, no doubt.
So Louis, Melbourne, I noticed that you believe it has the potential to some of the consequences of these businesses that have shut. And I've been told by friends, I don't live in Melbourne. I've been told by clients and people that I know that in many strips of Melbourne, businesses have not reopened. They sort of got highly impacted, and they made the decision they were shutting shop. Unemployment, all those issues potentially mean Melbourne is more the vulnerable place than anywhere else in Australia.
I would agree with that. We are pretty negative on Melbourne. We think it will be the underperformer for 2021. If we think we've got an issue with the unit market in Sydney CBD, well, Melbourne's got a larger issue, a far larger issue. So on our numbers, it looks like rents have fallen by more than 30% in the CBD area for Melbourne.
What about Louis?
We're still recording rises in rental listings.
Louis? Where are you? So I get the impression from that you're pumped about Perth, and following that, Sydney and Adelaide.
That is correct. That's generally where we think the outperformers are going to be. Darwin is also one which has really turned around, which I gotta say we've been scratching our heads on, because before coronavirus the Darwin economy was very soft. There wasn't much short to medium-term prospects for the local economy there. And then all of a sudden, we noticed probably about April, rental vacancy rates in Darwin started plummeting. And then the word on the ground we heard was there were a lot of Victorians moving to the Northern Territory all of a sudden. And I think one of the things that's going to come up is that there's been a bit of a mass exodus of Victorians, a bit of an interstate exodus of Victorians trying to get away from the state.
Yeah.
Due to all the lockdowns, etc. And Darwin's been one of the places they've been able to go to, because Darwin was one of the first, well, it was the first territory to open up its borders, which I think happened in June, if I recall.
Now, Louis, other things that you've mentioned in that report I read is that there are a few factors. Net migration in Australia will be lower, so there'll be less people coming into Australia in the year 2021.
Yes.
Which will have an impact. And most of the areas they would come, I would presume, is Sydney, Melbourne.
That is correct. So the budget estimates from the federal government is that we'll have a net outflow of people in 2021, and indeed the forecast is saying for 2022. So the government's been pretty bearish or negative on net migration. As we know, the border's been closed. Our view is that once we see the international borders open, the government will be very keen to put the pedal to the metal on net migration. They'll try and play a bit of catch-up footy in terms of bringing more people, encouraging more people to come to this country. And I think we're starting to see it a little bit now. I've been reading more news reports about the door being open for international students. But yeah, for now, Melbourne, of course, is one city which has relied over many years on net international migration, and they're just not going to see it next year, really.
Now, the other factor that you've mentioned is the land tax proposed changes that New South Wales have been talking about, and you see that as a positive in real estate.
I do. I think it's a massive positive for the New South Wales housing market, and I'll just take you through some of the key numbers as to why this is a big positive. As you would be aware, Tom, in New South Wales, the average stamp duty cost on a property tends to be about 4% of the purchase price, on average, about 4%. Okay, the change, should it pass Parliament, I don't see why it won't change, is that owner-occupiers will only basically pay no stamp duty if they opt in on a 0.3%, so 0.3 of 8% on the underlying land value each and every year, right? And let me tell you, there's a huge difference between 4% of the purchase price versus 0.3% of the underlying land value. And what it means is that you'll be better off as an owner-occupier to take up the land tax option in New South Wales for the next 25 years. So the break-even point on all this is about 25 years. And the truth is that most property owners own their property on average for about 9 years. So we think this will encourage lots of owner-occupiers coming to the market. They'll save thousands of dollars up front in not having to worry about stamp duty. And if they sell their property within 25 years, they'll be ahead.
Yeah, I love it. It's basically, dropping the barrier to entry into real estate. And that's only a good thing, because it means that there's a lot of people involved in transactions that are going to benefit the economy. Obviously, probably with that, there'll be more transactions taking place, more removalists, more mortgages, more real estate agent fees, more conveyances, more everything that's associated with it. But this at the moment, Louis, is a more New South Wales thing, isn't it?
It is a more New South Wales thing. Now, keep in mind, Victoria has also announced some stamp duty changes as well, which will mean that owner-occupiers will get a bit of a boost there too. They've lifted the stamp duty threshold by, I think, another $250,000 on a property. But the policy change is significant for New South Wales. It's way over and above what any other state's contemplating at this point in time.
You got it, Louis. To me, it's really obvious. Money's so cheap. It's like you've got to invest in assets because in cash, you're going nowhere. You're going backwards.
Well, Tom, I'll point this out to you and the audience. I've never seen a situation in my professional career, my personal lifetime, where the rental yield on a Sydney property is higher than the average lending rate.
Yes.
We're getting that right now. You can borrow money on the average variable rate now, running roughly at about 2.5% if you've got reasonable credit. The average gross rental yield across Sydney is running in the low threes. So I've never seen a situation where Sydney properties is cash flow positive on day one. Now, of course, that assumes you're getting a good tenant and you're not going to see further rent falls like what we're seeing in the unit market, but potentially that's what you can get right now in Sydney.
Louis, I ran into my accountant who I went to uni with. He's a friend of mine at the Bay Run this morning. And I was explaining to him about my taxation issue, which is an ongoing conversation I have with him, like everyone does, tax minimization. And he simply said, listen, you can't negative gear in this market. He goes, whatever you do, he goes, you want to go off, you can go borrow millions and millions and millions. The yield you're going to get is higher than the cost of money. The only way that you can actually, do negative gearing in this market is that you go off and you land bank something that has got very little income coming in, right? And you're borrowing money. But I think, Louis, and thank you for this very thorough, thought out report that you put out last week and sharing it with our viewers. And as I've said, you've always been, more accurate than most with things. You come from the world of real estate. That's probably unlike some other forecasters that are actually working for non-real estate organizations, and they want to throw their hat in the ring as their interest in real estate. Now, before you go, Louis, at the bottom of that report, so this report here is free, but there is a postcode boom or bust report that is $59.95. What's that report got in it?
Yeah, so what you've read effectively, Tom, is our summary report, which we offer to the media and to anyone who comes to visit the website for free. But those who want to, and this is really aimed for property investors, those who want to look up their postcode, what's happened on their postcode for the last 12 months, those who want to actually see our rental forecasts that we've made, which are in the report as well, and those who want to see all the reasoning behind all our thinking, running through far more detail the scenarios that we've got. This report's for you. So
is it $59.95 per postcode?
No, we wouldn't do that. It's a $59.95 for the whole report. So the report itself runs about 60 pages and covers every postcode in the country.
Okay, so Louis, how do they access that report? Because I can tell you, I'm going to buy, as soon as I hang up, I'm just buying the report, because I think anyone that's in the profession of real estate needs to sit there and sound like a trusted advisor, not a commission breath salesperson that's just sitting there winging it. You want to sit there and show that you understand key performance indicator data, levers, and essentially be someone that has actually studied their product knowledge, which is the real estate market in Australia. And so that report is on sqmresearch.com.au, or is it somewhere?
That's it, Tom.
And what do you look for? You look for a link that says boom or bust report.
It's on the front page of the website as we speak.
Okay, so Susan, please put that link in the comments. And we're going to email this out, Louis. I'm so pumped about this. I'm going to email this out to our 27,000 subscribers, and we will have the link there. So you'll get a few dollars for your time tonight, I'm sure. Right?
No, that's all good. I think one of our final messages to your audience, and I also know they're predominantly agents, is a couple of things here. Firstly, we are definitely seeing a pickup in volumes. and I'm aware to look for agents. It's been a particularly tough period, all the way stemming back from 2017. It has been tough. We had this window, of course, after the surprise LNP victory where volumes picked up, but then, of course, we had the issue of COVID. But we can see volumes are picking up, which is good news. Second thing I'd like to point out is that some of your audience would be aware we produce our own auction clearance rates these days. Yes. And for Sydney, we're recording clearance rates now in the 60s. And I think this is an important point, Tom, because I'm aware my competition or my peers reporting clearance rates in the 70s and 80s. I don't think it's that high. It's heading in the right direction. But when you're looking at your own book and you're getting, say, a clearance rate in the 60s, and you're seeing, say, Domain say, no, it's high 70s, and you think you're underperforming, well, you're not underperforming, right? The actual benchmark out there now is in the 60s. If you're getting clearance rates in the 60s on your book, you're actually doing okay.
So Louis, let's just clarify. The methodology that you come up with, that number of 60%, is properties. Just explain your methodology of auctions. It's what's got listed as an auction?
Yeah. So we look at the total auction listings, anything that's been advertised for an auction, but that must include the date that it's been auctioned, the address of the property. We can monitor all that, and we do that basically on a daily basis. Now, one thing not too many are aware of, like outside our industry, of course, is that when an auction's taken place and it's done, no matter whether the result is sold, passed in and still for sale, an agent changes their ad with the listing provider to tell the world the property is still available for sale or the property sold. They do that all the time. They usually do that within 48 working hours. So it normally happens by Tuesday after the Saturday event. And we monitor that. So we know straight away whether that property sold under the hammer or it didn't sell under the hammer, or it's sold after, or it's still for sale. So through all that, we're able to pick all that up, and we actually put that all online, every property by property, with the links so people can see for themselves. And that's how we're getting clearance rates in the 60s. I think that's where the market's at. The clearance rates have been rising, so there's no question of being rising. We're not saying they're not rising, they are rising. We just dispute the issue that they're in the late 70s and 80s. We don't think it's running that hard.
And the volume's up, Louis. The volumes
are up. My word, they're up.
I mean, the volumes, I don't know if you've got any numbers there, but I've got to tell you, next week is the 19th of December, next Saturday, right? And I'm working from 9 o'clock to 4:30. This is the week where people are shopping at Westfields, right? And I've got a full day of auctions. I've never had a December that many auctions in my life.
My word, Tom, I agree with you. If you don't mind, I'll finish off with just sharing this chart because it shows the clearance rates, right? If you can see this, what we've got here is a bar lines with volumes. On the left side, the counts weekly, and the clearance rate being the blue line, the light blue line. You can see the collapse we have with the clearance rate going into COVID, but since then, it's been picking up, and we're now over the 60s, and see the dark blue lines, volumes have been picking up, and we're now up to 1,000 a week. This week, it'll be over 1,000 a week. It's been picking up all the way through and into December, and it will be a late season. And my bet is we're going to see an early 2021 season. We'll actually start seeing volumes pick up prior to Australia Day. That's my bet.
Yeah. And looking at that chart there, Louis, I still see that April, I'm reminded of that. That was the rush when Scott Morrison went on TV and said, you won't be able to do auctions as of a specific day. And there was this big rush where auctions were brought forward, and you just had all these auctions compressed in that 1 or 2 week period.
That's right.
So that explains that big spike there. And then what we're having a look at, basically that chart is saying that volumes are going up, and so's the clearance rate. And that of course is for Sydney. That's for Sydney.
It's the same thing we're seeing in Melbourne as well, Tom. Volumes and clearance rates are rising. When you see that, especially for the spring selling season, normally, as you'd be aware, volumes pick up in the spring selling season, but then the clearance rate starts to taper off a bit, but not this year. Clearance rates are still on the rise, volumes are still on the rise, even basically 2 weeks out from Christmas. Pretty abnormal stuff.
All right, I'll get you to come off screen share and we'll finish up. Louis, thank you so much. And by the way, big shout out to SQM Research. You muck around on their website, you see so many things like interesting stuff like, you know, suburb salaries and what the average salary of a suburb is in a marketplace. You get all these things that allow you to actually, you know, it's good for me because I can sit there at an auction when I'm trying to buy 5 minutes when there's a negotiation going on, and I'll say, hey, by the way, did you know this and did you know that? It's useful information and data. And so if you're a real estate agent, put SQM Research under your favorites and check them out. And Louis, thank you so much. We'll talk again early in the next year. But the truth is, hey, the last conversation we had on Zoom, I clearly remember we hadn't actually left our houses for many weeks, and we were talking about, oh, one day the stadiums will be full again and people are going to be going out. That more or less has now happened. And in lots of parts of Sydney, Louis, there is really no evidence of what we've just gone through. I mean, you walk into the shops. Having said that, you'll be very proud of me, Louis. I got a glowing report card from the Office of Fair Trading that attended my auction yesterday, because they are out enforcing that real estate agents are covering the COVID safety plan and that are ensuring social distancing. So the Office of Fair Trading are the people that are policing that.
Oh, how about that? That's news to me. Very interesting.
Yeah. All right, Louis.
Thank you, Tom.
Thank you, everyone. Remember what you're all about. Be a trusted advisor, not just this needy salesperson that's just trying to get desperate for a deal. Provide information. Speak from a position of strength. Give people data. Help people make educated decisions. And right now, I've got to tell you, it's as good as I've seen it in real estate. It's good for buyers. It's good for sellers.